We're here to, cut through the noise and get you straight to those aha moments without drowning you in info. Today, we're pulling back the curtain on a part of the financial world that's often pretty mysterious, yet it really impacts everything, from how big institutions trade to how stock prices are actually formed. We're doing a deep dive into the, fascinating world of dark pools. Our guide for this is Erik Banks' really insightful book, Dark Pools, Off-Exchange Liquidity in an Era of High-Frequency, Program, and Algorithmic Trading. Think of this book less like a dry textbook and more like a secret decoder ring for understanding these hidden market currents. Our mission today, pull out the most important stuff, the key nuggets, so you can walk away with a really clear picture of what's going on behind the scenes, quickly and thoroughly.
Yeah, and this is it's more relevant than ever. Dark pools aren't some niche topic anymore. They represent a really significant chunk of global financial markets, though often misunderstood. Understanding them helps you appreciate, the real complexities of market structure today and how fast it's all changing because of tech and regulation.
Okay, so let's unpack this. What exactly is a dark pool? Can we get a plain language definition? And why should we, even care?
Sure. So imagine the regular stock market, like the New York Stock Exchange, as this brightly lit public square. Everyone's shouting their buy and sell offers, right? It's all out in the open. A dark pool, then, is kind of like a private room off to the side of that square. Hidden. It's a place where big orders, large blocks of shares can be bought or sold without anyone in that public square knowing about it, at least not until the trade's already done. The key thing is its existence isn't public knowledge. It's not advertised.
Okay, private room. Got it. But why care?
Well, because as Banks really details, these hidden rooms aren't small corners. They're huge. By 2013, he points out, they accounted for something like up to 40% of all U.S. stock trades.
40%?
Yeah, 40%. And their market share has grown dramatically across the globe. It's a massive, kind of invisible part of how our markets actually work now.
Wow, okay. 40% isn't a corner, it's like half the building. So what's driving this? What are the big reasons Erik Banks points to for this huge shift towards, trading in the dark?
Banks really zeroes in on four main advantages, and they're pretty compelling for the big players, the institutional investors. First off, confidentiality. Think about it. If you want to buy or sell, say, 1 million shares of Apple,
right,
doing that in the open market, everyone sees that huge order. That information alone can push the price against you before you even finish trading. Dark pools offer discretion, anonymity.
Okay, makes sense. What else? Second, reduced market impact. This is tied directly to confidentiality. If your giant order hits the lit market, other traders, especially fast ones, might see it and front-run you.
Meaning they trade ahead of you.
Exactly. They buy ahead of your buy order or sell ahead of your sell order, profiting from the price move you're about to cause. Dark pools help stop that, which can save institutions, serious money.
Okay. Confidentiality, less impact.
Third, cost savings. Because they encourage competition between different pools and often have lower fees than traditional exchanges, they can offer better pricing overall. And finally, number 4 is the opportunity for price improvement, or generating alpha, as traders call it. This often means getting your trade executed at a slightly better price than the best price publicly available at that moment. Maybe splitting the difference between the public bid and ask price.
Ah, okay.
So yeah, these aren't small perks. They're fundamental reasons why big money flows into these venues. This is really where it gets interesting, isn't it? Banks clearly packed a lot into this book. Let's try to walk through his main ideas, sort of chapter by chapter, to build up our understanding. So, chapter 1. Banks starts by just setting the stage, right? Defining dark pools, why they were first created. He mentions their rapid global growth and, crucially, how regulations actually help them along.
Exactly right. It's kind of counterintuitive, but yeah, their creation wasn't some rogue, unregulated thing initially. In many ways, it was spurred by regulations meant to increase competition. Things like Regulation ATS in the U.S., that's Alternative Trading Systems, and Regulation NMS, National Market System.
And MiFID in Europe.
And MiFID in Europe, exactly. Markets and Financial Instruments Directive. These rules basically said, hey, traditional exchanges don't have a monopoly anymore. They created a framework that allowed these alternative off-exchange venues to pop up and, thrive. So the rules didn't stifle them, they kind of gave them the green light.
Interesting. So the regulators sort of opened the door. Then Banks moves on, broadening the view to market liquidity itself.
Yeah.
Chapter 2, right. This is where you really get the why behind dark trading. Market impact, information leakage.
Precisely. This chapter gets into the nitty-gritty for traders. Banks really hammers home this idea of market impact. Like we said, a huge order hitting the public market moves the price. It's unavoidable. That's impact.
Like dropping a big rock in a small pond.
A perfect analogy. And then there's information leakage. If others see your intentions through your orders, they can use that info against you. Dark pools are designed to minimize both of those problems. Banks also talks about key aspects of liquidity itself.
Things like immediacy.
Yeah, immediacy, how fast can you trade?
Yeah.
Breadth, how much can you trade at the best price? Depth, how much is available at various prices? And resiliency, how quickly do prices bounce back after a big trade? Dark pools try to optimize these for big institutional needs.
Okay, so we've got the basics, the why, the market context. Then chapter 3 sounds like a field guide, the different types of dark pools. Because it's not just one monolithic thing, is it?
Not at all. It's a real ecosystem. Banks breaks it down. You've got dedicated crossing networks. These are platforms built specifically to match large anonymous orders, often at specific times or price points. Then, even on traditional lead exchanges, you can have exchange hidden orders, a way to hide part of your order size.
Oh, okay.
You also see liquidity in electronic limit order books, yellow lobes, where some orders might be hidden. And critically, there are the big broker-dealer proprietary desks.
Where firms trade for their own account.
Right, or match client orders internally off exchange. And you have agency brokers who specialize in finding dark liquidity for their clients across various pools. The key takeaway Banks emphasizes is that these all operate differently. Different rule, different clients, different technologies.
And this matters because...
Because you need to know who you're swimming with, basically. This leads to his concept of pool toxicity.
Pool toxicity. That sounds bad. What does he mean?
It's a really important idea. Imagine you're a long-term investor trying to quietly sell a big block of stock in a particular dark pool. But maybe that same pool is full of aggressive, super-fast, high-frequency traders, and they're constantly pinging the pool.
Pinging, like sending out feelers.
Exactly. Tiny little orders, just to see if they hit something big and hidden, like your order. Or they're trying to sniff out any information they can get. For you, the long-term investor, that pool becomes toxic.
Because they'll trade against you?
Precisely. You risk adverse selection. You end up trading at a worse price because the faster, maybe more informed, traders detected your presence and acted first. It's like showing your hand in poker. So understanding a pool's profile, who trades there, their strategy is vital to avoid getting picked off.
That makes a lot of sense. Okay, but if these pools are dark, how do they even price the trades? Chapter 4 tackles this, right? The pricing and execution.
Yes, and this is maybe one of the biggest aha moments in the book. It's the difference between price discovery and price derivation. Discovery versus derivation, okay?
Dark pools generally don't discover new prices. They don't set the market price through open bidding like a public exchange. Instead, they typically derive their prices from the lit markets. They look at the public exchanges.
And use that price.
Usually, yes. They often execute trades right at the midpoint of the NBBO, the national best bid and offer. That's the best available buy price and the best available sell price across all public exchanges at that exact moment. So they use that public transparent price as a benchmark for fairness, but without revealing their own orders.
So the dark pools actually need the lit markets to function.
Absolutely. They are anchored to the prices discovered in the visible markets, which raises a huge question Banks explores. What happens if too much trading volume goes dark?
Does it harm price discovery?
Potentially, yes. If the lit markets don't have enough volume, enough orders interacting, the prices they discover might become less reliable, less accurate. It's a really delicate balance. This whole thing fuels the debate about market fragmentation. Fragmentation, meaning the trading is split across too many places.
Yeah, lit markets, dark pools, internalizers. Liquidity gets spread thin, which can have benefits like competition, but also drawbacks like maybe not always getting the single best price available across all venues.
Okay, complex stuff. So
Yeah.
Chapter 5 gets into the actual trading strategies used in these pools. The rubber meets the road here.
Yeah, this is the playbook. Banks covers the basics, like block trading, just moving large amounts of shares, and program trading, trading a whole basket of stocks at once. But the real focus is on algorithmic trading, using computers to execute trades based on preset rules. This is totally pervasive now.
Algorithms like VWAP and TWAP.
Exactly. VWAP, volume weighted average price. The algorithm tries to break up a big order and trade it throughout the day to match the average price, weighted by volume, hides the order's impact, and TWAP, time weighted average price, spreads the order out evenly over a set time period, again, trying to be less visible.
Makes sense. Stealthy trading.
Very stealthy. And then he gets into the really high-speed stuff, ultra-low latency trading where speed is measured in microseconds, and those gaming strategies we mentioned, like pinging to find hidden orders.
That pinging sounds like a vulnerability.
It definitely can be for those trying to stay hidden. It highlights the constant cat-and-mouse game between different types of traders in these dark venues.
This all sounds incredibly tech-heavy. Chapter 6 must dive into the technology behind it all.
Completely. Technology is the engine making this whole dark pool universe run. Banks walks through the key components. You've got sophisticated order management systems, OMS, and execution management systems, EMS, on the traders' desks to handle the orders. Then, critically, the smart order routers, SORs. These are the brains deciding where to send an order to a lit exchange, this dark pool to that dark pool, seeking the best execution based on cost, speed, likelihood of getting filled.
The traffic cops of the trading world.
That's a great way to put it. And of course, within each pool, you have the pricing and matching engines that actually pair the buyers and sellers anonymously. He also mentions things like FX, the Financial Information Exchange Protocol. It's like a universal language for these systems, allowing them to talk to each other super fast, globally. Milliseconds matter here.
Unbelievable speed. So tech powers it, regulation enabled it. But Chapter 7 revisits regulation, focusing on control and transparency. It's not all smooth sailing, is it?
Far from it. As Banks points out, those initial regulations like ATS, NMS, MiFID, while fostering competition, also directly led to less overall market transparency and that fragmentation we talked about. And then things really came to a head with events like the flash crash in May 2010.
I remember that. The market just plunged.
Plunged almost 1,000 points on the Dow in minutes, then snapped back. It was terrifying and exposed real fragility. While the exact cause is debated, high-frequency trading algorithms interacting across fragmented markets, including dark pools, were seen as major contributing factors. It forced regulators and the public to confront the risks. Concerns about HFT, dark pool oversight, systemic risk, they all shot to the forefront.
So regulators are trying to balance things.
It's a constant tightrope walk. How do you keep the benefits to you? Dark pools offer confidentiality, lower impact for big investors, while ensuring overall market integrity, fairness for everyone, and preventing systemic meltdowns. It's an ongoing debate with no easy answers.
A tough balancing act indeed. Okay, so finally, Chapter 8. Banks looks to the future. What does he see coming down the pike for dark pools?
He predicts they're here to stay and likely to keep growing, driven by that institutional need and ever-improving technology. But he also sees significant consolidation. There are, dozens and dozens of dark pools. The market likely can't sustain that many. Efficiency will drive consolidation into fewer, larger players.
Makes sense.
Interestingly, he talks about a blurring of lines between lit and dark markets. Exchanges offering more dark features, dark pools becoming more sophisticated, maybe offering some pre-trade transparency in limited ways.
Yeah.
And he expects the concept of dark trading confidential matching to expand further into other asset classes, things like corporate bonds, maybe even some ETFs, where similar needs for quiet execution exist.
Fascinating. Okay, this has been a fantastic walkthrough. Let's try to really boil this down now. What are the absolute key insights we should take away from Banks' work?
All right, let's crystallize it. Here are, say, the top takeaways. 1, dark pools exist primarily for institutional investors to trade large blocks confidentially and with reduced market impact. That's their core purpose.
Right.
2, their growth wasn't just organic. It was significantly shaped and, frankly, enabled by regulatory changes like Reg ATS, NMS, and MiFID that were aimed at increasing competition.
Okay.
3, super important, they typically derive prices from the lit markets, using the MBBO usually. They don't discover prices themselves. They rely on the transparent markets.
Got it. Derived, not discovered.
4, advanced technology is absolutely fundamental. Algorithms, HFT, ultra-low latency, smart order routers, none of this works without the tech. 5, the rise led to market fragmentation. This has pros competition, lower costs maybe, but also cons, like potential price discovery issues and maybe not always getting the absolute best execution if liquidity is too scattered.
Fragmentation is key.
6, traders have to actively manage risks within dark pools, especially pool toxicity and information leakage, to avoid getting hurt by adverse selection. Know your pool.
Pool toxicity, right.
7, expect continued consolidation of the dark pool industry and look for these dark mechanisms to spread into other asset classes like bonds and ETFs. And maybe 8, the big picture. Dark liquidity is fundamentally about providing efficient, cost-effective, confidential ways for big players to transact, and that has profoundly changed market dynamics.
That's a great list of insights. Now, the ultimate challenge. Can you sum up the entire book, Banks's core argument, in just one single sentence?
Okay, let me try. Takes a breath. Banks' book elucidates how dark pools, these confidential off-exchange trading venues, have fundamentally reshaped global financial markets, driven primarily by institutional needs for confidentiality and reduced impact, enabled by technological innovation, and structured by evolving regulatory landscapes, ultimately having profound consequences for market structure, price discovery, and how trading actually happens.
Wow, that's packed, but it really covers it. Nicely done. Now, to really let Banks' voice come through, maybe we could highlight a few key quotes, the lines that really capture his thinking.
Yeah, definitely. Some quotes just stick with you, like the basic definition. A dark pool is an accumulation of orders to buy or sell assets, but whose existence is not publicly known or advertised. Simple, but that's the core. Then, explaining their appeal, dark pools provide all four of these advantages: confidentiality, reduced market impact, cost savings, alpha generation, which helps explain why their market share has risen dramatically. It just spells out the why.
Right, the motivation.
On the regulatory side, regulatory changes have been fundamental to the direct and indirect development and expansion of dark pools. Underscores that crucial link.
Can't ignore the rules.
The price discovery point. Non-displayed liquidity matched through crossing networks does not contribute to price discovery. That's a critical distinction.
Yeah, that's huge.
On technology. Algorithms have become ubiquitous, and technology-reliant high-frequency trading and ultra-low latency trading platforms have directed important order flows into the dark. Shows how tech drives the flow.
The tech imperative.
The warning about toxicity. Commingling investors-traders with very different profiles in a single pool can lead to varying quality of execution, a concept known as pool toxicity, a direct warning to participants.
Choose your pool carefully.
And finally, his balanced view on the future coexistence. The visible markets are essential anchors for the dark sector. It is quite reasonable to suppose that the two can coexist even as volume begins to favor dark venues. It's not a battle, but an ecosystem.
Those really capture the essence. This deep dive into Erik Banks' dark pools has certainly shed light on a pretty shadowy corner of finance. It really shows that what you see on the surface, those flashing stock prices on the news, that's just part of the picture, isn't it?
Exactly. It's only part of the story. And understanding these hidden mechanisms, it isn't just for Wall Street types. For you, the curious learner, it's about appreciating the, frankly, incredible sophistication, but also the inherent risks baked into modern markets.
Yeah.
It helps you ask better questions about how value is really exchanged and what forces are shaping the economy we all live in.
So what does this all mean for you? I think it means realizing that transparency in finance isn't a simple thing. It's this constantly shifting balance. Dark pools offer efficiency, they offer confidentiality, real benefits for some, but they also force us to ask tough questions. Questions about how reliable public prices are, whether execution is fair for everyone, and maybe even about the overall stability of this complex system. It's just a powerful reminder that beneath the surface, the market is always adapting, always looking for an edge, always that interplay between what's visible and what's hidden. Well, thank you for joining us on this deep dive into the world of dark pools. It's been fascinating. Until next time, keep asking those big questions, keep exploring, and keep looking beneath the surface.